And good morning, good afternoon, good evening, depending on where you are sitting in the world. My name is Michael Filighera, and I am going to be analyzing your trades today, but a little bit of background on me. I uh, have been trading for well over 40 years, and I started as an options market maker. And I've traded here in San Francisco, which is where I live. I also have traded on the London traded options market, the European Options Exchange in Amsterdam, and also on the German DTB, as I lived in Amsterdam for 10 years. And then I returned here to the United States, went back to the uh, Pacific Exchange, went back to the options floor. And then when everything basically, after 2000, everything really began to accelerate by going electronic, and the exchanges got very, very slow, and everybody started to leave. And I took the hint, and I also gave up my seat and went to set up myself in my home. I continued to trade options till about 2013, 2014, when I decided that I didn't enjoy the volatility anymore. And I decided to become a day trader. And that's what really my focus has been. I am moving back into trading more options now. I never really gave them 100% up. And so there's plenty of opportunity and in both options and the underlying and in the indexes. Um, so I think with the addition of zero DTE options in many of the ETFs, in fact, all the ETFs that I know, like the spiders, the Qs, the TQs, the SQs, the diamonds, all of the various ETFs carry zero DTE options. It's added an additional layer to how we trade and how quickly the markets can move. And actually, it's added an additional layer to how many of the markets we analyze them. So with that, excuse me, with that in mind, let me open the chat box, and I'll kind of leave that open so that I can see what will be coming in. And so go ahead and start to put in any symbols or areas that you want me to go take a look at. And in the meantime, I'm just kind of going to go over my S&P analysis and what I'm showing for the S&P. And I'm going to start here on the cash market, which is actually the foundational start for everything that sprouts off of the S&P 500. And I'm going to pull it out and go to my weekly chart. And I can just go to a 5-year weekly chart. So I'm basically considering that the market, the SPX, on a very big scale. So this is the largest scale that I am actually analyzing at the moment. And so that the market did top in January. In fact, the first trading day of January 2022, the SPX topped at 48.18. I do consider that the high and the completion point for not only an intermediate fifth wave and a primary fifth wave. Oh, sorry, I forgot to mention my primary technique or technical tool for analysis is Elliott wave. And I've been doing Elliott wave since 1988, 1989. My teachers were Robert Prechter and Dan Ascani. And so I learned very clearly from them and actually have been publishing and using Elliott for my own trading ever since. And at the moment, I continue to use it, but have noticed and have documented some of the changes that I've seen due to a lot of the changes we're getting into the underlying or even in the derivatives markets, and things that seem to elongate or shorten or change the structure of what we originally learned from R.N. Elliott himself. So on one hand, if you're a pure Elliott-tician, you could say that what's really coming about now really is not Elliott wave, because Elliott wave was written and designed and created by R.N. Elliott. So if we start making changes to that, then what does it become? It's taken me a while, but I am now understanding that those changes are necessary because there weren't any computers in the day of R.N. Elliott. There weren't any algorithms in the day of R.N. Elliott. Everything was done by hand. You created your chart by hand. You ran Fibonacci's by hand. You did all the calculations by hand. So to have the advantage where we get our screens built are just, we can follow them on a 2-minute basis. We can follow them on a tick chart and still find Elliott wave patterns. And that's the beauty that of Elliott wave in 2024 versus Elliott wave in 1944, that it's still applicable. And the basic reason that Elliott continues to be applicable in the marketplace, and no matter what actually you're analyzing, is because Elliott does not suggest that it has an understanding or that it includes fundamentals. So what Elliott wave is based on are human emotional reactions. So it's how we react to good news or bad news. It's how we as traders react to the different things that occur in a market day, even on a day trading basis, how we are reacting to a market that suddenly turns and runs against us or suddenly turns and goes for us. There are many emotions that are involved, which is a whole nother conversation. But what Elliott did notice is that as people reacted, it did produce recognizable patterns, and these patterns repeat. Now, that part of Elliott continues to this day. Patterns will repeat. And also that Elliott wave is essentially, when we're taking it from the largest time frame that we can come up with, and in fact, and for me, I can go out a bit further to my maximum chart, and then you'll notice I can go all the way back here to the beginning. It's 1928. So I can really look at data on the S&P 500 from 1928 to 2024. So we're really getting upwards of close to 100 years of data displayed on a chart automatically. It's kind of astounding. So when you really think about it, because it's a tremendous amount of data. And I have actually charted it. And how I started when I decided that I'm going to start producing charts and work on the S&P 500 and also the Dow, Elliott always told us that you start with the largest picture that you can get your hands on. And so for me, it was this chart that I'm looking at right now, which goes back to 1928. So I chose on this darker blue is actually a super cycle level. Now, super cycle is humongously long in time. And so I started it as Elliott left it. Elliott had marked the high that the markets did in 1929 as Grand Supercycle Wave 1. And his data, he went back into the 19th century because he had gotten a lot of data from London, from the London stock market. And so that's how he started to build for the Dow Jones. And excuse me. And then, so his second was the crash of 1929 and the subsequent, what came after, which pushed the country into, and the world, into a depression, was Grand Supercycle Wave 2. So using that as my basis for how I'm going to count from there moving forward, the next cycle down would be supercycle. That's what I use in sky blue. And then the cycle degree are the brick red. And then we have the primary are the green, the intermediate are yellow, the minor, which are way up here, you're going to have to see them, but they're all kind of clogged up there, are tan, the minuet are gray, and the sub-minuet are purple. So sub-minuet is a pretty small degree. You're going to see the minor on this very, very long-term chart you can't even see any of the minors. Now, the other basis is that, of course, that under Elliott, that what we are looking for, these are all building blocks. So when you get the first wave up and the second wave down, it's actually going to be the 1 and 2 of a larger cycle, and then et cetera, as they build. And then what's going to be inside. So what you have to understand is what's inside of a first wave up. And say, for example, a first wave of primary degree, which is what this was. Well, there's going to be 5 waves of intermediate degree labeled 1, 2, 3, 4, 5. So just getting the basics is a good way to begin. But in any case, being that they're stepping stones, being that they also we add Fibonacci. There's a Fibonacci number sequence, and Elliott also notated several areas where the markets pulled back to a Fibonacci retracement level, and how they moved higher and how different things came into play. And a combination of the two allows us to really continue to build and then use it in some ways as a forecasting tool. And the prediction or the predictability of Elliott on a large scale is there, but it's not, it doesn't, well, it can be very precise, but there have been a lot of arguments about what good is it, because we're now moving into new all-time highs, and I continue to call it a counter trend rally. I'll get to that in a moment. But anyway, so I start to move up as to where we are. And I just want to kind of look at, so that's the Great Depression. That's the 29 crash followed by the Great Depression. And then we started to build until we started to move out of these levels. So grand supercycle, cycle, primary, and now we're starting to build. What we're building is that cycle third wave. And what's going to be inside that cycle third wave? 5 waves of primary degree. There's 1, 2, 3, 4. This was part of that was the great financial collapse of 2009. You can say when we really put this into perspective to the overall long-term picture, it's almost unrecognizable. To be honest with you, that's the crash of 1987. And those of you that may have actually been around and trading, we really did believe that it was the end of the world. Yes, I guess you can use that cloud for further confirmation of a buy point. That I don't disagree. I don't have enough experience or knowledge on that particular instrument. But here, the great financial collapse, this is the pandemic. And those of us that were trading in that time in 1920 felt like the world was coming apart at the seams. And it did appear so. When you were having days in the Dow that would be down, 1,700, 1,800 points, where the NASDAQ would be down 700 or 800 points. The S&P was down like 250 points in one day. And it was just kind of crazy. So I'm bringing it back down so that we can actually start to apply what we're looking at. So again, in degree, I've got it all the way up to, so cycle wave 3 completing in 2022. And then we move into what I consider a cycle fourth wave. What that cycle fourth wave is going to consist of is a primary degree ABC. And then for in primary wave A, which is complete, what was inside that? 3 ways to be labeled intermediate degree. And we can back it up to, well, what was in intermediate wave A? 3 waves labeled minor degree. So you get A, B, and then you get the C wave down. Then we get 3 waves for wave B, and then we get a 5 wave for wave C. So there are rules and stuff to go along with that. So basically, from October of 2022, under my analysis, we have been tracing out a primary B wave counter trend rally. Now, understanding that what the structures are telling us, back in this time frame, in the October of 2022, when I put that low in and I put the primary A there, I began to lay out the track for what the primary B wave could do. Well, one of my calculations would be that B waves can be irregular. And what that suggests in saying that is that the B wave, in this case, would go up and create a new high above the starting point for wave A, or the completion point for this case, the cycle degree fourth wave. So this is all within the boundaries set that for what the market can do. Now, here we are. What's going to be inside this primary B wave? 3 waves of intermediate degree labeled A, B, and we are in intermediate wave C. Now I can bring this down, and I'm going to put it back down on I'm going to bring it down to my daily. So what's going to be inside this C wave? It's going to be 5 waves of minor degree. There's minor 1, 2, 3, and 4. So in my view, we're in minor wave 5 to complete intermediate wave C, which will in turn complete primary wave B and set the stage for a much stronger decline, not the end of the world decline, but a strong decline, a correction, to put the low in for cycle wave 4. What follows cycle wave 4 is going to be a cycle fifth wave back up, which wherever this tops out, it will be exceeded plus, plus, plus. A cycle fifth wave will not necessarily follow exactly the cycle third wave, because that cycle third wave began in 1932, I believe. Let me go back one more. Let me go back out to that. So I get this right. No, cycle third wave began in 1949. So the supercycle wave 3, which we're not done yet, that's the one that began in 42. The grand supercycle wave 3, which began in 1932, that's not even close to finishing. So what are we working on here when we get up and we kind of finish the cycle fourth wave? We're going to do cycle fifth wave. Well, we come back all the way down to here, and we then take it all the way back up to wherever this fourth wave bottoms. And that's going to give us our levels initially for where cycle wave 5 should come in. Coming back down to here, if I'm looking for this thing to top out somewhere around 5,400, maybe as high as 5,500, and then we come back down and we retest that low from 2022. So it's actually, it likely is going to come back in 38 down to about 3,300. It's going to be a large correction simply because of the numbers, but in terms of reality, it backs down to the levels that we saw 2 years ago. And so what gets corrected is basically all of this. And for a myriad of reasons, it's not, and again, I've often talked about, we're not saying that AI is dead, by no means, because it's very functional and it's going to grow. I'm not saying that the companies are bad. Time correction and rebalancing. The correction, in my view, being that it's going to be on a primary degree. If we're looking at how these have done, primary wave A was about 10 months. Primary B is not complete yet, but it's now also that was 12, it's about 15 months in. So I'm thinking we're reaching that. And then the C wave, I would suspect would be similar to the A wave, and about maybe 10 months coming down. So I think that we're looking at going into 2026, or depending on when this stops, maybe mid 2025 towards the fourth quarter of 2025. So I do think that we could or even sooner, because it's just, timing and it is subjective, to be honest with you, in my view. There are Fibonacci cycles that can go, and there are also time cycles that are very effective within the markets. And in fact, most of them are still engaged in on a short-term basis. But what is propelling our final push higher is primarily artificial intelligence. It's truly a handful of stocks. And I think what also contributes a great deal to our intraday moves are zero DTE options. So we have so many different things, and they will continue to play a very large role because there's a great deal of capital that is being used to trade. There are a lot of products that trade. There are a lot of different, moving in and out and moving from here to here. You're talking about rebalancing. I don't rebalance anything, so I don't really go and talk about, well, when is this great rebalancing going to be? I think it's actually underway already, to be honest with you. We see that they'll move out of one and put it in somewhere else. They'll move out of this sector and go over to that sector. Then I think that that is happening much more frequently than people realize. So, but within this move, if I bring it down now, I just start coming back in. And here we can start taking a look right within the last portion of it. And there we have minor 1, minor 2, minor 3, minor 4, minor 3, beautiful, elongated, beautiful wave. And so what I have beyond that is that we're in minor wave 5. Now, minor wave 5, I thought at one point could be forming a triangle, a diagonal triangle, which would be very fitting for this finishing move coming up here. Very, very fitting. But I stepped back and thought, no. And that it isn't forming the necessary patterns that they are, at least in the cash market, seemingly coming in as they should. And that wave 1 is 5 waves, wave 2 is 3 waves. This was a 5 wave, and not necessarily forming the 3-3-5, excuse me, the 5-3-5 type that I'd be looking at a diagonal. Plus, it's not actually moving it into that direction. Now, what we're finishing up here within this minor 5th wave, which will have 5 waves of minute degree, we have minute 1, 2, and then we're finishing up minute wave 3. So we still have additional upside to go. But cyclically, there's some intermediate term and shorter, monthly cycles that are kind of flashing a warning sign that a correction is imminent. But this correction might be 5, maybe 8%. So again, not the end of the world. But what we could be looking for, if you're a trader, if you're a position trader, if you're an index trader, even if you're an options trader, there's going to be plenty to do, and you can make a lot of money in that little correction. Even a 5% correction. 5% correction from current levels is basically going to take us back to maybe 49.75, but I'm going to say a lot higher. I don't even think we get down to that type of a level. I think maybe we can get back to, first level is going to be here. Second level may be down into here. But when you're up here, if it's a 100 or 150 point drop in the market, could produce. Now, if we get up here and do a 3, we're going to do a 4, your first one's going to be right here. So if it gets up to 53, it maybe drops back 150 points, or maybe even a little bit lower. Now, there's a lot to be said because there's differences between the cash market and the futures market. The future trades pretty much 24/7, or we can say 23/7. We do close between 5 and 6 each day. There's no activity in the futures. We close, the regular session closes at 1. They get an extra hour. It closes at 4. We get an extra hour until 5 p.m. Eastern, and then Globex restarts at 6 p.m. Eastern and goes again until the following morning, when the US markets reopen at 9:30 Eastern. So there's basically the cash market closes, the futures market continues. So you'll see differences in the two, between the two. I try to keep them close at hand so that we can see it. But I feel that this market, this green line, that's the primary. That's the primary degree marker. And that is where wave B would be 1.382 times the length of wave A. That is common. That is most common for an irregular B wave. We're not there yet. That's at 53.25. And then I have an additional group cluster that goes from 53.25 up to 54.15. That signifies the end of minor wave 5. And then I'm looking to add for when I can get up to, minute wave 5. And I'm thinking that we're likely going to start to roll into this area. There is a shot of 5,500, even a little bit higher. But people, you can see, you can do Fibonacci numbers and get yourself up to 62. That's never going to say, you'll never hear from me say that's where the market is going. It's when I develop a cluster that's where the market tends to head, get caught, and then turn. Now, and then depending on, is it going to turn in a larger correction, a smaller correction, and then that can all be fit in. So it's a building blocks. And the trend remains up right now. I call it counter trend because the largest trend I have going is on that cycle degree, and that is corrective. Right now, since October of 2022, it has been counter trend. So it has been up. There are no suggestions yet, even on a cyclical basis, that the market is ready to start to break down or start to negate additional upside possibilities. The level that's been given here for me in the SPX is 51.32. A break below 51.32 will start to weaken the uptrend. And then continued break would then knock it out, and we would consider the market would then have turned and will start to correct back down. Now, again, as I said, I do not believe that the upside on a long-term basis is done. I don't see there's reason if you're a money manager or a portfolio manager or even an RIA, a registered rep, that there are particular reasons to go to your long-term holders, your long-term traders, and start saying, blowing the whistle, like get out of longs, get out of longs. People that manage money will shift it out as need be. And so, because there's still, I think even in a strong enough downturn, I think that all the markets will participate. And why? Because everybody seems to now put their money into ETFs. Instead of choosing particular stocks, they're all in the ETF, and that's really what trades, and that's where a lot of the 401k money, the IRA money kind of just gets put right there. It's easier for investors not to have to focus on, oh, well, should I be putting it in Apple? Should I go into NVIDIA? Or do I want to stick with IBM? Or do I want to, where do I want to put my money? Where now you can put it in an ETF, which represents a larger sector. So, and that is just seemingly an easier way to trade. So we're seeing the inflow and outflows, excuse me, the inflows and outflows within the market really flipping around a lot harder. And so, but they tend to kind of go in little groups. NVIDIA continues to control AI at the moment. And so when you see a big move in NVIDIA, but now we have super microcomputer, that's in there. That's the newest add to the S&P. And that's garnered a lot of, interest. And then we go over and look at the options, and they trade extremely heavily. So putting all that together, that's what's really controlling our markets. And so when we have zero DTE, then you're going to add another factor in, and it's called gamma. gamma, which shows you the rate of your position that will change delta-wise per dollar move in your underlying. But guess what? It's hard because even in the SPX and in the ES, I mean, the ES used to trade per tick, right? And there were 4 ticks to the dollar. The NASDAQ does not trade on a per tick basis. So the NASDAQ mini is $5 per tick. And then there are, 4 ticks to the dollar. The NASDAQ trades in dollars. It'll move 5, 6, 7, 8, 9, $10 on one swing, one order. The S&P used to be so heavily bid on both sides, bid and offered, where it didn't get pushed around 5 or 6 or $7. Well, now it's that those bids are much, much less. So the institutional involvement is still there, but they're not coming in to say, well, I'll buy 250. I'll just sit there with a 500 lot order and changing it around. It's getting all spread out. And so the S&P moves a lot easier. So does the Russell. So does the Dow. So again, that movement has produced a lot of volatility, and it's the volatility that we're now measuring. So now we have volatility indexes, and we have derivatives on those volatility indexes. And so even trying to follow volatility these days presents its own challenges, because it used to be, well, if the volatility is so low, it's showing complacency in the market. Not necessarily, not anymore. Or we're going to get this volatility spike and we're just going to see it go running up. That may still happen, but not to the level of what we have seen in the past. And it's the way that the market trades those products and what they are using. We see a lot of things. It's called the dispersion trade. And when the dispersion trade is enforced, and it goes two ways, it goes both ways. But when they are selling the VIX, they're selling the volatility, they're usually taking that cash and they turn around and they're buying the volatility of the underlying. So when that happens, what is the end result? Well, if you're buying premium, and I'm a dealer in Apple or any of these stocks, and you're buying the premium, so you're buying calls, what's my hedge? I sell you the call, I have to buy the stock. So it's a self-fulfilling prophecy, but you can see it in action. So do people, do we put that together? No, we just, oh, it's bullish. It's never going to go straight up. It's like, well, there's usually can be a different reason that comes behind it. So to say that when this falls, it's going to destroy a lot of traders and buy the dippers, I'm not so sure, to be honest with you. For one thing, there are so many different types of trades that can be put on. Yes, some traders were going to get surprised because they're holding along and they're not willing to get out because they feel that you're going to you're in it for the long term, et cetera, et cetera. So I think that what happens is if traders are if they're in managed accounts, or even if they're smart enough traders or active enough traders, I should don't sorry about using the word smart enough. If they're active enough traders and they're taking an active position, you could be long something, but you might have puts underneath it. Or you could be long puts and your hedge is buying the underlying. So, and it's just how you decide to put your position together. There are ways to roll. There are ways where you're buying volatility out into 2025 or even late 2024, and you're just selling front month volatility and you're rolling that. And so it's a hedge trade. So there's so many different styles of trading, and there's so many algorithms in play that it becomes very difficult to put a finger or a pin in to say, well, this is going to happen or that's going to happen. Because I think trading has become very, very complex, and so are positions. But without a doubt, I don't say nay to the whole idea that many traders will lose money. those that run and operate their own 401ks may lose a lot of money because they won't get out. We've seen this happen in the past. Do people learn from their mistakes? I have no idea. I don't go that far. But you do get gamma squeezes. With this, if the market just suddenly takes a dump, consider if it's an expiration. It can happen every day, and it's an expiration. And often, well, for example, not last Friday, but the Friday before, for the March monthly, so it was the 15th, that expiration, I think there were so many larger traders that were like, would be damned if they're going to let NVIDIA close or expire anywhere close to 900. And what do? They just ran it. And if you notice, it really was a straight down. They just hit it. And that then, like you just said, this person just mentioned, that forms a gamma squeeze. And what happens if you are, if the market is dropping, your gamma explodes in your face. And what do you need to do? So if you're long, you're going to have to sell into weakness. And on the put side, you're going to have to buy into strength. And that squeeze hurts. That is where many, many traders lose their money. Not understanding how all of this works and how it's put together. So, and understanding that there are so many markets. We have our equity markets, and we have the ETF market, then we have the treasury markets, and we have the futures markets. Then we have the underlying, and then all of the options that are on the underlying. Let me just kind of show you something. I'm sure many of you already do this, but here's NVIDIA for today. These options expire on Thursday. Because again, Friday, holiday, so we have our expiration on Thursday. So you can see there's the volatility, 51.97. It's high, but for NVIDIA, pretty fair. And then we're down here to the March 1000. So they're $54 out of the money. And people are willing to pay $1.70. Now that's really come down quite a bit. So you're going to take your shot that between now and Friday or Thursday, the 28th, NVIDIA is going to trade at 1,000. Well, 59,505 are. Or are they selling that and buying the underlying and then maybe looking to take in the put? I mean, there are reversal conversions. There's so many different types of positions that you can put on, and they work, and you make money. Or are they putting a vertical spread on, where they're selling that and maybe buying something else? But we can watch these, and you can see that what really can go on. And let me just see this. I'm hearing from, let me see, that I have two people, Tekatami and Ken Seastrom, are raising your hand. We don't have an open mic here, so you're going to have to put whatever your question may be in the chat box, and then I can see it there. So what my attempt here is just to look at what happens NVIDIA, and then this is the other one, super micro, 99% volatility, because this thing moves 20, 30, 50 points a day. All right. Now, these also expire on Thursday when the bell rings at the close. And so, but it already had this $1,125 upgrade, or a price change or whatever. And look what there, $1,125, 1,000, paying $12, $1,125. So it's not more than it's more than $125, right? Plus 30. So it's like almost $150 out of the money, and you're paying $12.40 for 2 days. That's a lot. So when you see that, it brings a lot of people in who are willing to sell that premium. And you can get squeezed, hence, gamma squeezes. So again, there are just so many. Here's the basically, let's see, because it's actually slow volume. As Anka mentioned, it is slow volume. Now, these are the options that are expiring today, and it's slow. Look how many contracts have traded. And we're basically just an hour into the afternoon. 281,000, 266,000, 51, 52, 521, 522s, right? Volatility gets crushed real easy here. But still, that's a lot of options. And so you've got a lot of other options that they play against. Look at the puts, the 521 put. This is where the big boys come to play. They come into the spiders. They come into the Qs. So when we have an understanding, I think at the same time about, well, what's actually behind all of our moves? Look at the Qs, 143, 166, 447. Got close. In fact, we got above it and we came back down. You can just go running for them. And the thing is, it's like if you start to sell those and you can buy those, well, you know what? You're probably going to make some decent money. So that's what's getting behind our trading. That's what gets behind the market moves. It truly, it almost as if it stopped being a conversation on bullish versus bearish. It's technical and it's quantitative. And so we each will choose, like I did catch the tail end of Anka's, and she has algorithms. She has methodology that we have a support level, it went above, and here's, she had what the market will do, and then that produces how she chooses to trade. And that's really what's at play. Is it really presenting a bullish picture? Well, it might be, but to me, it's like, are we still bullish on the market? It's like, I don't know if I'm bullish on the market, but I think the market continues to go up, and I think we make additional new highs via the indexes. So it's just going to be what are the human emotional reactions going to be? What does everybody really feel? So, but my point here is, on a slow day, there are still, that's high. Those are high volumes. Look at things like the SQs, which are just continue to nosedive, right? This is the ultra short Qs. Look at these. That's a lot of options. Look at this, 55 million, and that's probably low for today. That's how many of this ETF actually has traded. And there's a lot of day traders in the Qs because they've studied. I know, and I can't remember his name, but David actually had him on, and he was on one of the larger sessions. And boy, I was glued. I was glued to how he was trading. He was just, very real fast, and it was amazing. And making $250, $300 on one trade, and it was only moving 5 cents. So again, if you understand your product and you understand what you're doing, and you have your signals, and you trust your signals, boy, there's a lot of trading that can be done. That's truly why I have basically become a day trader. Now, TQs, look at that. TQs used to be the one that was at about, $15, and the SQs were $58. Now that has reversed simply because we're in a counter trend rally. But we're going to watch this all reverse again. If we go through a larger correction and go back down towards in the TQs or in the Qs, if we're going to go back down from like 450 down to 250, that's a pretty big move. And these will go back down to, $15 while the SQs could jump them back up to 58 or 60. And there'll be plenty of trading. That's the other thing that I kind of wanted to include. It's like, to me, being really limits what your capabilities of doing. When I was an options market maker, yes, I put on directional positions. But what you learn real quick is that what positions can I put on and what's the purpose? What am I doing? I'm making a market for anybody that wants to come in and trade this particular option class. So I'm putting out a bid and an offer. So what I need to do is learn how to hedge that bid and offer so that no matter what the directional play may be, I'm not going to get buried. And then learning that you have positions where you can do that via a spread, via a reversal conversion, putting on a butterfly, putting on a broken wing butterfly, putting on an iron condor. Each one has a specific purpose that takes care of a market or looks for a market that's going to maybe trade in a box, trade in a very tight range, break out, break down. So there are positions that you can put on and trade. Again, I'm not really getting anybody that has anything that they want me to take a look at. So what I will take a look at, just because, is some of the other things that I do when I'm on the crowd forecast. I also go over quite a few things. Now, in gold, we've switched out to the June contract. And so it produces a much higher high. So this has not quite caught up. So you can see on the hourly chart, here's the high at 22.47. If I could take it down to my 4-hour chart, it's not quite there. So they have to give it another couple of days, and this will all be integrated, and it'll be very smooth. But gold has caught a strong bid, but I've been following gold for quite some time, and I have felt that it needed to rally, but it kept getting stuck. And in fact, even now, I'm looking at my weekly chart. I'm like, boy, you're just off to a very slow start. You need to go. Gold, you need to just go. Just start to break and not stop. That's how I will speak in terms of where I think it's like, if this market truly is going to go out and respect this count or concur with this count, if we're in a minor fifth wave up, which should be very dynamic and look better than this third wave, boy, we're off to a very slow start. These moves have been dynamic. Hands down, they've been dynamic. But from my understanding, this was some guy in Asia getting blown out. His clearing firm came in and closed out the position. Boom, and it was rejected immediately. And then there was another one just the other day. I'm like, same deal. Did somebody get closed out? Because it runs up and then it's rejected immediately. So I'm like, oh, okay, well, we'll see. But at the same time, the underlying factors for gold are starting to turn more positive. Can they retain that positive? What used to propel gold should still do so, but it's now what other people think. Gold's superiority in terms of a safe haven bid are getting shifted. We're seeing a lot of that turn and go into crypto, and in particular Bitcoin. But Bitcoin is where the big boys play. But I want to tell you something. With the advent of the ETFs, oh my God, the ETFs have brought so much money into Bitcoin simply because people don't have to come up with, where is Bitcoin now? I have to see, $70,000 to buy one coin. They can take that, whatever, 50,000, 25,000, put it into an ETF and participate in this. And that has just drawn in billions of dollars. Well, where's that money not going into? Well, maybe it's not going into the equity ETFs. It's not going into the treasury ETFs. It's not going into the gold ETFs, silver ETFs. But yet, gold does have positive underlying factors going for it. And I think a lot of what's happening in Bitcoin is it's catching that bid again as a safe haven, as a means, where can I put capital, right? Because we're going to have a digital dollar and it's just going to happen. And there's all kinds of news and stories around that and what's going to happen. You're all going to lose your money because the government's going to have this and that. That may be so, but fear tactics don't seem to work. But in any case, I still do like gold. And I do have a target right now, and doesn't have to be long term. I'm on a weekly chart, so that could be over the next month possibly. I mean, we basically have already gotten up to 2250. That's basis the June contract. 2340 is my next level, and then I got levels above that. 2500. And then you got people out there talking 3000, 5000. It's like, well, sure, I can show you those. I just add on to this guy. I just put the next fib sequences up there. 27, 29. So I'm at gold 3000. But am I saying that that's where it's going to go? Very likely eventually, but when, I don't know. Too many other things are going to happen in between. Gold was a storehouse of value, continues to be a storehouse of value. And there are many reports that you can read about as to why. And a lot of comparisons have been made in terms of how much gas did an ounce of gold buy in 1930? How much did it buy in 1970? How much did it buy in 1980? How much did it buy in, as you continue to go on? How does gold react in a period of inflation or a period of deflation? What happens when currency and paper money and the fiat currency, that's the big scary part. The fiat currency, the piece of paper that we keep in our pocket, what happens when that no longer has any value? Right? When it is worthless. What do we barter with? What do we trade with? What do we do? There are a lot of unanswered questions. Digital dollar. Notice who also, just speaking of the digital dollar or the digital yuan or the digital rupee, or the digital ruble. Check out which central banks are stockpiling gold. China, Russia, Indonesia, and we also have there's a whole bunch that are in the Middle East, Saudi Arabia, United States, that they're backing gold. China actually got it going and Russia followed suit. And then India followed suit. India's always been a big player in the gold market on a consumer level, but now the government, and because you have to consider it's like China, when they want to have the yuan as the currency of choice, the global currency of trade. It's still the US dollar. So the US dollar must back that thing with something other than the good faith and credit of the United States. So we have gold. China, I believe, is backing their digital yuan with gold. Because to tell me it's electronic, and gee, what backs it up? What makes it worth anything? Nothing. Well, then why would I want it? So there's a lot of stuff going on behind all of this stuff. So in essence, I'm gonna wrap up. We didn't really get anything else other than gold and the S&P. I do think that we still have upside left in the market. As we've heard, like I heard from Anka, who I respect her work tremendously. I am still looking for additional upside, but I do believe we are close to a smaller correction. And then once we get the next leg up, we will likely start to drop in that stronger, what I'm considering a primary C wave decline. And that decline, I believe, will take at least a year. So you're very welcome, Lee. Thank you. Um, and what comes after that is another economic expansion. It's going to be very interesting, folks, because it's just like it's not the end. And it's like just really study how to trade, study what products, what you can be doing. Instead of just going, the world is coming to an end. Yes, there's going to be dramatic change, and yes, on a global scale, there'll be dramatic change, and there are many things that could trigger something even more severe. But you don't have to stand there and be hit in the face before you go and do something about it for yourself. There are a lot of things you could do, but don't play into the scare test tactics. Trading without fear is a major feat to accomplish. But there'll be so much to trade. That's all I can say. There will be so much to trade. I don't care if the market drops 10,000. There'll be a lot to trade, and you'll be taking money out of the market. Let other people panic. You don't have to panic. One of the things I used to say, and I probably shouldn't, is I love panic. It's a time in the marketplace where the volatility is so nuts and so crazy that you could buy or sell something and just wait a minute or two and make 100 points. So day trading is really crazy. My website is www.tradershelpingtraders.com. That's one of them. I'll just put that in right now. I also operate a trade room, and you can check out the trade room. And I'll just lay it all out. I charge $299 a month for the trade room, but here is what I attempt to do, and I try to share with everybody each and every day. I try to make at least $300. So I try to make the cost of my trade room every day so that people can pay for it and then make a lot of money in the process. Also, if you have interest in the trade room, on tradershelpingtraders.com, there is a tab to go to the trade room. You can sign up, and I will get notification, and I will come. Again, it's $299 a month. The trade room meets every day. We start at 6 a.m. Pacific Daylight Time, and we run to 8. So the first half hour is between me and my colleague Sasha Goring, who happens to be in Germany, and we present our overnight analysis and what we're expecting for the day, and we are very detailed because we're day traders. So we're down to a 5-minute, a 50-minute, a 2-minute chart. So we try to lay that out. No, there's no trial, but that's what I'm trying to tell you. It's $299 a month, and I will hopefully make that month for you on the first day. And it's not you don't make there's no long-term commitment to staying in the trade room. So it's like if you come in, you decide, you know what, I made a little money, but it's not for me, then you're not obligated to continue. There's also, I have another website, and that is logicalsignals-trading.com. That one is actually it's kind of an umbrella, and it's yes, that's day trading futures. And yes, it would be a $300 commitment period. That would be it. That's all you're committing. And hopefully you're going to be able to make that money on the first day or the first week. Let's put it that way. So you can pay for it. I also, and I'm going to be quick on this one, I also put out a daily, so it's actually Sunday through Thursday. I have a daily update on the S&P and the NASDAQ, and it's called the Elliott Wave Update. On the weekends, I do a podcast called Eye of the Storm Podcast, where I'm usually going over the big picture on a technical basis. And sometimes I have guests on the podcast, and then sometimes also Sasha